For 80 years, the world has treated the IMF as the adult in the room. When currencies collapse, it arrives. When governments overspend, it prescribes discipline. When markets panic, it speaks with authority. Its reports move bond yields. Its conditions reshape national budgets. Entire generations of policymakers were trained to believe that if a crisis spirals, the IMF will contain it. But that assumption is aging, because the IMF's real power was never just money. It was leverage. It was the ability to say no, to impose terms, to make access to the global financial system conditional on compliance. And for decades, countries had little choice but to accept. That era is fading. Nations now hold trillions in foreign reserves. Regional lending blocs are expanding. Rival development banks are financing infrastructure without Western conditionality. Major powers are splitting into financial spheres of influence. Countries that once feared IMF programs now design strategies specifically to avoid them. The institution is larger than ever. Its lending capacity has grown. Its mandate has expanded into climate policy, inequality, and fragile states. And yet, its ability to dictate outcomes is quietly narrowing. This is the uncomfortable truth. The IMF is not collapsing. It is being outmaneuvered, not through open rebellion, not through dramatic withdrawal, but through diversification, hedging, and strategic non-compliance. The world is building alternatives in plain sight. And when the next global shock hits, the question will not be whether the IMF has resources. It will be whether anyone is still willing to surrender control. Power does not disappear all at once. It erodes at the edges. It frays in the details. It weakens not when institutions collapse, but when they begin to enforce rules no one fully intends to follow. For nearly 80 years, the International Monetary Fund stood at the center of the global financial system. It was built in 1944 at Bretton Woods as the stabilizer of last resort. Its mandate was simple in theory and immense in consequence. Maintain order in a world of sovereign currencies, sovereign debt, and fragile post-war economies. When nations faltered, the fund arrived with liquidity. When balance of payments crises spread, the fund imposed discipline. It became the referee of the global monetary game. And for decades, the system worked. Not perfectly, but predictably. Countries borrowed. The IMF conditioned assistance on austerity, reform, and structural adjustment. Budgets were cut, currencies devalued, subsidies removed. The medicine was painful, but it reinforced the architecture. Access to dollars, credibility in bond markets, and reintegration into global trade all flowed through compliance. The authority of the institution rested not only on its capital base, but on belief. Belief that its rules were enforceable, and that defiance carried consequences. But control is not the same as power. Power is visible in headlines and voting shares. Control lives in compliance, coordination, and credibility. And over time, those are harder to measure and easier to lose. In the late 20th century, IMF programs shaped Latin America, Eastern Europe, and parts of Asia. In the early 21st century, they shaped Greece and the Eurozone periphery. Each crisis reaffirmed the fund's relevance. Each intervention seemed to strengthen its centrality. Yet beneath the surface, the incentives began to shift. Emerging economies accumulated reserves to avoid ever needing the IMF again. Regional lending pools were created, bilateral currency swap lines expanded, sovereign wealth funds grew. China established parallel financial institutions. Countries that once accepted conditionality without leverage slowly acquired alternatives. The IMF did not shrink. Its lending capacity expanded. Its staff deepened its technical expertise. Its programs grew more complex. But the system around it changed. Today, global debt levels sit at historic highs. Major economies run persistent deficits. Geopolitical blocs are hardening. Sanctions fragment payment systems. And emergency lending has become routine rather than exceptional. The fund remains powerful on paper. Its resources are larger than ever. Its surveillance mechanisms are more sophisticated. But control depends on something more fragile than balance sheets. It depends on a shared acceptance of hierarchy. That hierarchy is now contested. not through dramatic exits or formal withdrawals, but through quiet diversification, strategic ambiguity, and selective compliance. Countries no longer reject the system outright. They simply build escape routes. This is how institutional authority shifts, not with collapse, but with dilution. The IMF is not losing relevance. It is not disappearing. It is not being replaced overnight. It is losing something subtler. It is losing the ability to compel outcomes in a world that has learned how to hedge against it. And that process is already underway. Every financial order follows a sequence. It begins with scarcity and coordination. It matures through credibility and enforcement. And it strains under the weight of its own success. The pattern is economic before it is political. First comes concentration. In the aftermath of crisis or war, capital consolidates around a central institution. Liquidity flows through a narrow channel. Rules are standardized. Participation brings stability. The institution gains leverage because alternatives are weak, fragmented, or non-existent. Second comes expansion. As global trade grows and capital markets deepen, the central authority scales alongside them. Lending capacity increases. Surveillance becomes more sophisticated. Conditionality becomes codified. The institution evolves from emergency responder to permanent overseer. Its legitimacy hardens into doctrine. Third comes adaptation by the periphery. Nations that once relied entirely on the central authority begin to internalize its lessons. They accumulate foreign reserves. They reform domestic banking systems. They reduce exposure to external currency mismatches. On the surface, this looks like success. In reality, it is the first quiet step toward autonomy. Fourth comes redundancy. Parallel systems emerge. Regional funds, bilateral swap agreements, sovereign wealth buffers, new development banks. None of them replace the central institution outright. Instead, they dilute its exclusivity. Access to liquidity becomes diversified. Conditionality becomes negotiable. Enforcement becomes selective. Finally comes constraint. The institution still exists. Its voting structure remains intact. Its capital base may even expand, but its ability to dictate outcomes weakens because borrowers are no longer cornered. Compliance becomes strategic rather than obligatory. Programs are designed not only around economic fundamentals, but around geopolitical alliances. This is the stage where control erodes. The IMF's original strength rested on asymmetry. Countries in crisis had few options. The fund could demand fiscal consolidation, structural reform, and currency adjustment because the alternative was isolation from global capital markets. Its leverage was rooted in necessity. But as global capital markets expanded and foreign exchange reserves ballooned, particularly in East Asia after the 1997 financial crisis, many emerging economies resolved never to face that asymmetry again. They chose self-insurance. Trillions of dollars in reserves were accumulated not for growth, but for independence. At the same time, creditor nations gained leverage over the institution itself. Voting shares reflected post-war realities for decades. Rising economies demanded reform. Governance adjustments came slowly. The perception of imbalance lingered, and perception shapes behavior. When participants begin to question fairness, they quietly hedge. The defining feature of late-stage institutional strain is not open rebellion. It is diversification. Countries borrow from multiple sources. They negotiate conditionality across competing lenders. They treat multilateral programs as one tool among many rather than the ultimate authority. The IMF remains central. But centrality without exclusivity is different from dominance. History shows that when enforcement depends on coordination among major powers, fractures at the top weaken discipline below. If leading economies disagree on priorities, lending terms soften. Conditionality becomes inconsistent. Exceptions multiply. Over time, the institution adapts to preserve relevance. It broadens its mandate. It incorporates climate risk, inequality metrics, and development goals. It modernizes its language. But structural leverage does not expand simply because mission statements do. The pattern is not about disappearance. It is about dilution. And dilution is difficult to reverse once alternatives become permanent. To understand how this unfolds in practice, it helps to look backward at earlier systems that appeared unshakable until their control quietly slipped beyond recovery. In the early 17th century, global trade revolved around a narrow set of financial centers. Among them, the Dutch Republic stood apart. The creation of the Bank of Amsterdam in 1609 transformed fragmented coinage into standardized money. Merchants across Europe trusted its ledger balances more than the metal in their own vaults. Settlement became efficient, risk declined, confidence deepened. The Dutch did not dominate through conquest alone, they dominated through infrastructure. Shipping networks, insurance markets, joint stock companies, and disciplined fiscal management created a system that others relied upon. The Dutch guilder became a reserve currency of its era. Capital flowed through Amsterdam because it was predictable. Predictability is control. At its peak, the Dutch Republic financed wars, underwrote trade across continents, and extended credit far beyond its borders. Its debt was large, but it was manageable because investors believed in its governance and commercial supremacy. Borrowing costs remained low. Its institutions were considered neutral, rational, and stable. Then, expansion reached its limits. Rivals adapted. England studied Dutch finance and replicated its innovations. The Bank of England emerged in 1694, combining sovereign debt management with growing imperial reach. British naval power expanded, trade routes shifted. The same tools that once gave the Dutch an edge became transferable. Meanwhile, the Dutch faced rising military costs. Maintaining maritime dominance required escalating expenditures. Debt levels climbed, tax burdens increased. The economy matured but stopped accelerating. Growth slowed while obligations persisted. Nothing collapsed overnight. Amsterdam remained wealthy. Dutch merchants remained skilled. The Bank of Amsterdam continued to operate. But the asymmetry that once favored the Dutch narrowed. Creditors diversified toward London. Trade volumes migrated. Political fragmentation within the Republic complicated unified decision-making. Control faded before power disappeared. By the late 18th century, the Bank of Amsterdam's credibility faltered after covertly extending large loans to the Dutch East India Company. When those exposures surfaced, confidence weakened. The institution that had once symbolized discipline had quietly compromised its own rules to support national champions. Trust eroded, not because the system lacked resources, but because its neutrality was questioned. The Dutch financial system did not implode in spectacle. It was overtaken through redundancy. London became the new clearinghouse of global commerce. Sterling displaced the guilder. Capital followed growth, and growth followed scale. The Dutch experience reveals a recurring sequence. Institutional innovation creates dominance. Dominance invites imitation. Imitation erodes exclusivity. Rising costs strain fiscal balance. In response, institutions bend their own standards to preserve influence. That bending weakens credibility. Alternatives solidify. The system continues to function. It simply ceases to command. The IMF was born in a moment not unlike early Dutch ascendancy, a period when coordination was scarce and institutional design provided order. Its authority rested on enforceable standards and centralized liquidity. For decades, countries in distress had no comparable alternative. But as history shows, once participants learn the mechanics of the system, they begin building parallel structures. They replicate the tools. They internalize the lessons. They seek autonomy. The Dutch did not lose influence because trade vanished. They lost control because trade no longer required them. That distinction defines every transition, and it appeared again in another era, under different conditions, when a financial center believed its position was permanent. In the early 20th century, London sat at the center of global finance. Sterling anchored international trade. Bills of exchange cleared through British banks. Capital moved across continents underwritten by the credibility of the Bank of England. The gold standard reinforced discipline. Convertibility signaled strength. Britain's dominance rested on three pillars: industrial leadership, naval supremacy, and financial intermediation. Even as the United States and Germany industrialized, London remained the clearinghouse. Borrowers from Argentina to India raised funds in sterling. Confidence in British governance and its imperial reach kept capital flowing. Then, the costs of maintaining supremacy accelerated. Two world wars strained public finances beyond historical precedent. Debt ballooned, gold reserves thinned, industrial competitors gained scale. The United States emerged not only as a manufacturing powerhouse, but as a creditor nation. New York's financial markets deepened, dollar liquidity expanded. After the First World War, Britain attempted restoration. Sterling returned to gold in 1925 at a pre-war parity. It was a declaration of continuity, a signal that the old order still held. But the underlying math had shifted. The exchange rate overvalued British exports, growth slowed, unemployment rose, deflation tightened the domestic economy in order to defend credibility abroad. The defense of control imposed internal strain. By 1931, pressure became unsustainable. Gold reserves drained as investors questioned convertibility. The government suspended the gold standard. Sterling depreciated. The symbolic center of global finance had conceded that its rules could no longer be enforced at acceptable cost. London did not vanish as a financial hub. British banks continued to operate. Sterling remained used in trade. But the asymmetry had flipped. The dollar system expanded through Bretton Woods. The United States held the gold. The IMF itself was structured around that new reality. The critical phase was not the abandonment of gold. It was the years preceding it, when policymakers insisted stability could be restored by reaffirming old commitments, even as structural conditions had changed. Publicly, authority appeared intact. Privately, leverage had diminished. This is how systems age. They respond to mounting constraints by tightening standards or broadening mandates. They emphasize credibility. They invoke legacy. Yet the environment around them evolves. Creditors diversify. Borrowers explore alternatives. Rival centers accumulate liquidity. Britain's leaders believed sterling's role was anchored in tradition and trust. They underestimated how quickly trust can reprice when economic fundamentals shift. Once capital finds another channel, it rarely returns out of nostalgia. The IMF emerged as part of the architecture that replaced sterling dominance. It institutionalized coordination rather than relying on empire. But it, too, depends on shared belief in its enforcement capacity. The British case demonstrates the moment when maintaining control becomes more expensive than relinquishing it. The external commitment collides with internal realities. The rules remain on paper. Compliance becomes conditional. Today's global system does not mirror the interwar period exactly. The scale is larger, capital moves faster, currencies float rather than peg rigidly to gold. But the pattern, rising obligations, emerging alternatives, and mounting tension between credibility and flexibility, feels familiar. The environment shifts gradually. The acknowledgement comes suddenly, and the transition rarely announces itself in advance. The modern financial order rests on an architecture built after 1945. The dollar anchors trade and reserves. The IMF monitors imbalances, lends during crises, and coordinates policy advice across continents. The World Bank finances development. Central banks communicate through established channels. For decades, this structure absorbed shocks, from oil embargoes to emerging market defaults to the global financial crisis. Its resilience is real, but resilience is not immunity. Global debt has climbed to levels unprecedented in peacetime. Advanced economies carry persistent fiscal deficits. Emerging markets manage external liabilities in multiple currencies. Private capital flows dwarf official lending. Sovereign bonds trade in volumes unimaginable when the IMF was founded. At the same time, the geography of growth has shifted. Asia accounts for a growing share of global output. China holds vast foreign exchange reserves and has established new lending institutions alongside its Belt and Road financing. Regional arrangements such as the Chiang Mai Initiative provide liquidity buffers in East Asia. The BRICS nations have expanded their coordination, creating the new development bank as a supplementary source of funding. None of these mechanisms replace the IMF outright. they do not match its global reach or technical depth, but they narrow the gap between dependence and choice. After the Asian financial crisis of 1997, countries like South Korea and Thailand experienced the severity of IMF conditionality. The lesson they drew was not rejection of global integration, but accumulation of self-insurance. Reserves surged across the region. The objective was clear: avoid returning to a position where external terms dictated domestic policy. Meanwhile, advanced economies themselves have stretched fiscal boundaries. During the 2008 crisis and the pandemic shock of 2020, coordinated monetary expansion stabilized markets. The IMF expanded emergency lending facilities. Conditionality was softened to accommodate extraordinary circumstances. Programs became more flexible. Flexibility preserves relevance. It can also blur discipline. Sanctions regimes and geopolitical fragmentation now complicate financial coordination. Payment systems are being diversified. Digital currencies are under development by multiple central banks. Cross-border settlement no longer relies exclusively on a single channel. The IMF still commands significant resources. It still shapes reform programs. It still conducts surveillance and publishes assessments that influence markets. But its authority depends on cooperation among its larger shareholders. If those shareholders diverge strategically, enforcement weakens. A system built on consensus struggles in an era of blocs. The modern parallel to earlier transitions lies not in imminent collapse, but in gradual hedging. Countries engage with the IMF while simultaneously strengthening regional alliances. They participate in multilateral frameworks while negotiating bilateral credit lines. They comply selectively. Control becomes negotiated rather than assumed. And once negotiation replaces necessity, the hierarchy shifts, even if the institution remains standing at the center of the stage. Late-stage systems rarely look fragile. They often appear strongest just before strain becomes visible. Liquidity is ample. Markets function. Lending facilities expand. Official statements emphasize coordination. Data dashboards update in real time. From the surface, complexity resembles control. But complexity can conceal drift. When global debt rises faster than growth for extended periods, servicing costs compound. As long as interest rates remain low and confidence holds, refinancing appears routine. Governments roll over obligations. Corporations issue new bonds to retire old ones. Investors search for yield and accept compressed risk premiums. Stability becomes self-reinforcing. The acceleration phase begins when multiple pressures converge quietly. Interest rates edge upward. Currency mismatches widen. Fiscal space narrows. Political constraints limit reform. None of these shifts individually trigger crisis. Together, they tighten the margin for error. Institutions respond by expanding tools. Emergency facilities multiply. Special drawing rights are allocated. Lending frameworks are revised. The objective is to prevent localized stress from becoming systemic. For a time, this works. Yet the more frequently backstops are deployed, the more markets incorporate them into expectations. Risk pricing adjusts. Borrowers assume access will remain available. Creditors assume coordination will persist. Discipline becomes contingent on continued support. This is the paradox of advanced systems. The mechanisms designed to stabilize volatility can, over time, encourage greater leverage, not through recklessness, but through rational adaptation to perceived safety nets. When a shock eventually exceeds anticipated thresholds, whether geopolitical, financial, or structural, the response requires unprecedented scale. Coordination must be faster. Liquidity must be larger. Consensus must be broader. If consensus fractures at that moment, the limits of control become visible. Acceleration does not mean immediate collapse. It means compression of time between stress and response. Markets move in hours, capital exits in seconds. Information spreads instantly. Institutions built in slower eras adapt, but their governance processes remain deliberative. Voting shares, board approvals, conditionality negotiations. These take time. In an interconnected financial system, time itself becomes scarce. The appearance of stability can persist even as flexibility narrows. And when flexibility narrows, authority depends less on formal power and more on voluntary alignment among participants. That alignment is the most fragile asset of all. History does not repeat with precision. It repeats in structure. Institutions rise when coordination is scarce and uncertainty is high. They consolidate authority by offering stability in exchange for rules. Over time, success breeds imitation. Imitation breeds alternatives. Alternatives reduce dependence. And reduced dependence reshapes incentives. The IMF was born from crisis and constructed through cooperation among dominant powers. Its authority has always rested on a delicate balance between enforcement and consent. When countries enter its programs, they do so because access to liquidity outweighs the cost of adjustment. When major shareholders support its mandates, they do so because stability aligns with their strategic interests. But incentives evolve, emerging economies grow, creditors diversify, domestic political pressures intensify, voters question austerity, governments weigh sovereignty against integration. Major powers reassess alliances. None of these shifts destroy an institution, they alter the calculus surrounding it. Control, in this context, is not about coercion. It is about predictability. It is about the confidence that rules will be applied consistently and that coordination will endure when tested. When predictability declines, participants hedge. They build reserves. They sign regional agreements. They experiment with alternative settlement systems. They accept multilateral frameworks while ensuring they are not trapped within them. This is not rebellion. It is rational adaptation. The IMF remains embedded in the global system. It retains expertise unmatched in many areas. Its data informs markets. Its programs still shape policy in countries facing acute stress. It has expanded its toolkit to address climate risk, inequality, and fragile states. But expansion of mandate does not automatically restore exclusivity. The lesson from Amsterdam and London is not that institutions fail abruptly. It is that control fades quietly when participation becomes optional rather than essential, when compliance is strategic rather than obligatory, when leadership is negotiated rather than assumed. The current moment carries no dramatic proclamation. There is no formal announcement of transition. The IMF continues to operate, to lend, to advise. Yet beneath the continuity lies adaptation on all sides. Nations are learning to navigate around concentrated authority without directly confronting it. Major powers are recalibrating commitments. Financial innovation is decentralizing settlement and liquidity provision. The system remains intact, but its center of gravity is shifting. Power can persist long after control begins to thin, and by the time that thinning becomes undeniable, the transition is already advanced. If you're watching for the first time, welcome to the Economy Club. This is where we study the forces that shape history and the patterns that quietly decide the future. Stay curious, stay grounded, and we'll see you in the next cycle. The answers aren't hiding in the future. They're written in the past, and I'll show you where to look.